I think the biggest thing is the concept of like unknown unknowns are what can absolutely screw you. And meaning like that's where the business loses money, that's where you lose money, that's where things go wrong. And figuring out like what unknown unknowns are is extremely difficult to do if you don't get to know people who have kind of been through your shoes and can provide advice and kind of help steer you around those roadblocks. So um, I would tell me 10 years ago to or my kids if they were 10 years younger to do everything they possibly can to identify unknown unknowns and try to figure that out. And then I think the secondary thing is I would tell younger me or kids to go values first.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. Scaling single-family residential rentals. How in the world do you do that? Better question, why in the world would you do that? What an amazing conversation today, because we're going to look at a different approach. We're going to reverse engineer this process to where we could put together even 300 to 500 of these single-family residential houses in elite school districts. These are areas where guess who wants to buy these groups, packages of them, hedge funds. And these big boys reversing back from that direction, reverse engineer this back and say, okay, this is what they're looking for. This is where, how, when they're going to do this, and then create this acquisition machine that's going to cash flow along the way. Man, this is very interesting. You're going to enjoy this conversation. Today's guest is the GP, the general partner for Scholastic Capital, graduating from Wharton School of Business, and here today with experience in the world of real estate as well, building this new fund with this new strategy. Everybody, please welcome Sean O'Day to the show. Oh, so we're starting off here, and I see Green Bay Packers on today's guest sweatshirt. So before we get anywhere, first of all, Sean, welcome to the show. Green Bay, where are you coming to us here from today?
This is gonna be like it's gonna make it even worse. I actually live in the Chicago suburbs, but
Oh, wow.
I spent a lot of time in Wisconsin growing up. I lived in Wisconsin when I was 5 or 6. So I've been a Packers fan since then.
Wow. So in Chicago, looking at Green Bay in Wisconsin, over there in Wisconsin, they say. I love it. So I grew up actually in Michigan. So I spent first 40 some years of my life in Michigan. And I'm now down in the Carolinas. So there's just something in me that's still liking the game Sunday, which is yesterday. We're recording this, and the Lions just beat the Packers. Lions are 6-1 prior to this game. Packers were 6-2, I believe, prior to that game, and the Lions got them, huh?
They did. And they played well. Packers didn't, and well deserved win in the Lions column and a big L on the Packers side.
Damn, man, Dan the man, too, the coach for Lions. So we won't get too far into the sports here because we're going to talk about real estate. But man, I had to come out with that. I absolutely love football, and it just leads me into the idea of Dan and how a program can change from the leader, changing the program from the top down. And we'll talk about that a lot in real estate, whether it's entrepreneurship, in medical practices, what have you. It's just something about a leader that can change the entire game for sure. So Sean, welcome again to the show. Here we are. This is the Real Estate Mogul MD. We oftentimes have physicians on here. Obviously, all of our listeners are going to be physicians. Tell us a little bit about Sean.
Yeah, for sure. So originally from the Chicago area, I live here now. Moved 22 times in the interim before I went off to college, which is what got me interested in real estate. Yeah, it was quite a bit of moving. And I went down, we'll call it like a very traditional business path. So I went to Wharton's undergrad program, finished up working consulting for BCG for a couple of years, and had a thesis from real estate from the beginning due to kind of all that moving so much. So as soon as I started making some capital on my side for my job, started buying some real estate, and then compounded to the point where other folks wanted to join in, and now it's a full-fledged fund.
Interesting. So I share a little bit of that journey, having moved. My parents
Hmm.
built a house when I was 7 and built it for a long time. Never actually finished it. Lost it to a short sale. Not necessarily lost it, but had to sell it on a short sale. And from there, we moved like every 12 months. We moved. It felt like. So I can empathize with you on that journey. It also made me interested in real estate as well too. So
Okay.
when you started acquiring, Sean, what was it that you acquired?
Yep. So I started buying single family homes and started buying single family homes through the lens of really actually like a consulting lens. I did a lot of private equity due diligence work when I was in consulting. And the lens that we would always take there is like, what gives one company a right to win versus another? Like why does Coke have an advantage to get a customer who wants to drink a cola versus Pepsi? Like there isn't really one besides brand. The product is the same. Um, but I was thinking about it from real estate, like what can I do to give my product a competitive advantage that another one doesn't have? And I kept on coming back to the concept of school district being that of like, hey, if you buy the home in the really good school district and it's the only home in home in the area in the really good school district, and there's a tenant who wants to get into that school district, like you've got the competitive advantage in the eyes of that tenant. So started buying homes specifically under that thesis.
So single families, and I've got your website open here, scholasticcapital.com.
Mm-hmm.
And just looking at this, and one of the sections actually says thesis. So is this, I heard you say thesis a minute ago. Is this exactly what you had prepared for school? The thesis that you have there? Or is it different? Is a thesis of the
Um,
business?
It's a thesis of the business.
Okay.
Although it's an idea that I've had since I was called a teenager, really, from all the moving so much. My mom was a teacher. Every time we moved, it's like, oh, there's a really good school here, and like people are trying to get their kids into the school, and everybody knows that school in the area. So I did do a bunch of work on it specifically when in school, but thesis from like the business standpoint.
Okay. And I see the markets that you're in. Talk to us a little bit about the markets that you're in, and then I would love to get into returns and the whole process here for you.
Yeah, for sure. So we are very much trying to reverse engineer this from the end. And for us, the objective is we're trying to build a really strong portfolio that provides cash flow and all that now, but we're building this for sale. We're building a portfolio that we want to sell to a Blackstone, a Tricon, an Invitation, someone like that 10 plus years down the line. So we've been pretty intentional about spending as much time as we can with those institutions of like, hey, if we build you this portfolio, where would you want it to be? The consistent answer that we've gotten back from them is upper Midwest is where we would be most excited about a portfolio in, call it the mid 2030s. So we are intentionally building it in the upper Midwest, so we have the ability to sell them that nice portfolio in a decade or so.
Interesting. And I've always looked at single family real estate from the outside in, and
Mm-hmm.
Illinois is probably one of the last states that I would want to acquire in, especially in Chicago. Tell me a little bit about your risk mitigation when it comes to being in a state where it's more tenant friendly than it is owner friendly, landlord friendly.
It's a good question. I think the big byproduct for us is um, our tenant base is very strong. Our number one most common occupation for our tenants is physician. Our average tenant makes 220 plus $1,000 right now. We've got surgeons who are making seven figures as tenants. So as a result for that, like we have literally never once in our history had a tenant pay a late rental payment penalty because we've never had a tenant be late in the entire history of our fund.
Very interesting. So increasing that, and it's based off of not only the tenant but the areas that you're in. The name of it, Scholastic Capital, basing it on school systems. So, what to you? I see all these little bubbles in the Chicago area on your website here. What to you stands out about a school system that says, "Hey, I want to invest in this area long term"?
So we think about it from like a supply and demand perspective. So the demand driver is the school district. That's why people want to live in this particular town versus the town over. And there's a lot of data that we look at that helps us figure out what that is. Um, as an example, like our favorite data set is we've got one that shows the percent of the high school graduating class that goes to Harvard, MIT, or Stanford. It's the most predictive data set we have about rental premium. There's kind of a magic bump where if you got above a certain percent of the high school graduating class going to those three schools, your rent is about 60% higher than the town over. So
You said
that's
what percent higher?
60.
60%. Interesting.
Mm-hmm. So that's on the demand side. On the supply side of the equation, we are very intentionally trying to buy in areas where there is not rental supply. We're looking for areas, median home ownership rates in the country is mid 60%. We're looking for areas where the owner occupancy rate is 90%. We're looking for areas that don't have buildable land left. We're looking for areas that have historically blocked multifamily development. And then when you combine those two together on that supply and demand element, like you've got a really good reason to want to be in that area, the really good school district, and you don't have a lot of rentals available at the same time because there just aren't. Most people own their homes there, and there aren't multifamily properties. There's no land to build new rentals, and that's what creates kind of this pricing pressure, which pushes up the rent. And it's why we're able to charge kind of a pretty significant rental premium.
Inside of these, and I have a direct line of questioning forming in my mind here, so work with me here a little bit.
Let's do it.
So I'm seeing Wisconsin, Illinois, and Indiana. And Indiana looks like you're just outside of the Gary area. Is that correct?
Call it halfway between Gary and Indianapolis.
Okay. So a little farther out of Gary, because Gary I would not put as one of those areas that you would be in with those requirements. So how long have you been doing this?
So two different answers to that. The first is I've been doing this with my own capital for 4 or 5 years now. From the fund perspective, we launched this a fund about 6 months ago. So it depends on where you want to count the start on that.
Okay. So 4 or 5 years ago, 6 months ago, 6 months ago on the fund, how many properties have you acquired?
We've got 21 right now. We're buying about 3 or 4 homes a month.
21 to 3 or 4 a month. And your acquisition in these areas, what does that look like? Are you off the MLS?
We are off MLS. We have a couple things that we're going to start doing that is off market in the next, call it, few months. But for us, the vast majority of our acquisitions are on MLS, and they'll probably stay that way as well.
All right. And how many different areas are you in? So I see 3 states really on this map on the scholasticcapital.com on the thesis page.
Yep. We're in 12 different zip codes right now across those 3 states. And we are very shortly going to add Minnesota and Minnesota and Michigan as well. Speaking of Michigan earlier. So we'll be basically hugging the Great Lakes.
So 12 different zips. And currently 3 different states, looking to add Minnesota, and over to Michigan, not up in the Uper area. I'm sure you're probably going to be closer to around Detroit. I'm imagining maybe Grand Rapids.
Those are the two areas that we like in Detroit, in Michigan.
Yeah. Very interesting. And now looking at the price point in these areas, I'm looking at an average house here, a 2-bedroom. 3-bedroom, 2-bath, 1,760 square foot, kind of like that real bread and butter of a rental area, without getting into age and a few of these other parameters. You're saying the purchase price of just under $500,000. What is the average rent then that you're looking at for a purchase theoretically like that?
Yeah, so right now, average purchase price is $4,700. Average rent is $3,500, not counting pet rent or any additional fees on top of that.
Okay, so how does that cash flow?
We actually are cash flowing pretty substantially. It's about 5 to 6% cash flow for us. It's a combination of a couple different factors, but the largest is like we've got 30-year fixed debt on these portfolios and 30-year term debt. So we're not doing like the 10-year notes with balloons, which by the fact that we're amortizing the debt over 30 years, like it makes the actual cash flow exist for the homes.
Okay. Yeah, I'm just trying to work this out because it's nowhere near that 1% rule, which would typically is still difficult to cash flow on a leveraged scenario. So, and I also saw that you're at like 65% LTV on a loan. So you're leaving
Hmm.
funds in here, and you're coming out and they're on that 5 to 6% after, is that reserves coming out or how? I'm struggling seeing how that cash flows.
I mean, we can walk through some like specific examples of some houses, but that we're able to get there from a cash flow perspective. I mean, our largest line item is property taxes by far because we're in high-end school districts. Like the
Yeah.
property tax bills are substantial. Um, our maintenance bills are lighter than the traditional SFR. Um, they are still a non insignificant number. But we're actually interesting if you look at us compared to like an SFR REIT. SFR REITs, they're typically maintenance expenses are by far their largest, and property taxes are second. For us, it's the inverse. Insurance is very nominal for these homes. It's one of the reasons why we're buying Upper Midwest is because the SFR funds have told us they are afraid of the insurance issues in the Sun Belt, and that's why they're moving up to the Midwest. Um, Property management is very negligible for a portfolio of our size and where we're trying to get. Um, it makes the cash flow pretty consistent in terms of what we're actually getting on the homes.
And that 5 to 6%, what are you actually netting per month per door then? Like what's your target?
Uh, from a dollars perspective or percentage
Yes, sir.
perspectives?
Dollar. Yeah, dollar.
Dollar perspective depends on the home. Like our cheapest home is $395 that we purchased, and our most expensive is $570. So like the dollar amount can range pretty dramatically depending on the purchase price.
Right. So the cash flow per door per month, I mean, you got to hit some parameters of what's acceptable here. What's the range of the bottom? Like what does it absolutely have to hit in order for it to still be a deal?
6% unlevered cost on yield is what we want from a going in perspective. And then once you hit the 6% unlevered yield on cost, you're right. We do have reserves. There's some drag on the portfolio from reserves because those are sitting in
Okay.
treasuries and that's foreign change.
So slow me down. I'm not financially educated, so I don't know what all those terms mean. Help me see this as just a simple landlord here. You said
For sure.
unlevered. So help me understand. If you have
Hmm.
this house, call it easy, call it 400,000. With a four hundred
Okay.
thousand dollar house,
Hmm.
how much you've got 65%
Hmm.
loan, right? So 400 times 0.65. So you're at a 260 loan. And then you've got, we're not, thinking all the
Hmm.
closing costs and all that stuff. So that means you still got 140 cash in this thing with a $260,000 loan. That particular scenario, what does that investment have to do every single month in order for it to pass the green light parameters,
Got it. So we've got 140 in it. So your unlevered yield on cost, meaning like if you don't have any, like how much is this home actually generating? We need it to be to 6%. So if you got 140K in, you're at 6%. That's like going to be 8,000 and change. So then if we're talking about it from like a monthly perspective, it would need to be like $700 and change to be hitting those thresholds. And that's 700 and change, and that's after a maintenance escrow. So I think one of the big things that people screw up in SFR is if they don't have a maintenance event in 1 month, they're like, great, I made a lot of money this month. It's like, no. Like you have to put the money into escrow every month because even if you don't have a maintenance event that month, like you need to be still escrowing it. So you still have to be paying into that maintenance amount each month. So it would need to be hitting like 700 and change for that to actually work.
And that 700 is above your debt service covering the debt service and the maintenance that you're requiring there.
Mm-hmm.
Taxes, all of that stuff has to come out of there. And
Mm-hmm.
okay, and you're still targeting that 700 to get a 6% return. And then ultimately, it sounds like you're setting these up to where the real return is on the exit.
That's largely right. Like the cash flow, like the way that we think about it is like it's like basically a dividend that somebody's getting. And if you like build up a waterfall of our total return, about 40% of it comes from the cash flow. The remaining 60% comes from the actual sale of the portfolio down the line.
And that sale is based off of the appreciation of the asset. Is that correct? That's what you're
Uh,
targeting for the other
it'll
40?
be it'll largely be based off of the value of a portfolio. So like if we were to sell the homes individually on the MLS to mom and pop buyers, it would be an appreciation play. What we're trying to do is get a portfolio of, let's say, 300 homes together and sell all 300 as a package. And in that case, they'd be valued off a cap rate, and we would get some built-in value for the fact it's 300 homes kind of already assembled and put together into that package.
Interesting. And 300, is that your target with the fund then?
Uh, we want to get as close to 500 as we can get over the next decade. We have to hit a minimally 100. We won't be able to sell it as a package unless we hit 100. 250, there's a pretty noticeable jump up in the premium that we will be able to get for selling them. And then above 500, it's counterproductive because there's fewer buyers available for a portfolio of that size. So somewhere in that like 250 to 500 range is your sweet spot. Ideally, you want to get as close to 500 as you can get.
Interesting. What's been the biggest challenge for you so far in this process?
There's been a lot of them. It's kind of it's a day-to-day battle. I think some of the biggest things is, especially if you're doing single family or any real estate in the scale, is those like long tail things that's like, oh, like this would never happen. Like if you have enough homes in the portfolio, enough units in the portfolio, like they will happen. It's the law of big numbers, and those things can add up from like a time commitment perspective. Like I can give you an example. One of our homes in Indiana, there was long story short, a gentleman was driving down the street, passed away while driving his car, lost control of the car, drove the car into the house. Like that's one of those like 1 in a million type situations. But if you have enough homes, like those things happen, and like as you build a bigger and bigger portfolio, like those things happen. So being like our team being built up to the point where like we can manage those things and take care of our tenants in those situations is by far the hardest part. And where we spend the most of our time is like building the process and systems to handle those kinds of things.
What software are you using to manage these assets?
So we have a property manager in place, and they use a software called Propify, which is a property management software built for single family. We use a software called Oyster that is like our system of record for the underlying assets as well. And then that is on top of like a Power BI dashboard, which is where we really spend most of our time.
A powered VI?
Power BI, like Power Business Intelligence is what I think it stands for.
VI. Okay.
Yeah, it like pulls in all of the data from all of the homes. It's actually really nifty, but it gives you a really good snapshot from like a forecasting perspective, like what's happening in the portfolio, where are there issues, and how can you start fixing them.
Power BI dashboard. And then this, you say you got one property manager, but you're in 12 different zip codes. How does that work?
So they're a national company. So they specialize in single family portfolios that are large, and they kind of touch a lot of different states. They're in the Carolinas as well, for example.
Okay. Very interesting. So managing these things, how about acquisition? What's been the biggest challenge for you in acquisitions? Because that definitely could be a bottleneck.
Acquisitions is tough. The biggest challenge for us is really data and making sure the data is working fast enough for us. Our offer. So right now we're winning 55.1% of offers that we place, which we're happy with. But the reason why we're winning those offers is because we built custom software on top of the MLS So when a home hits the MLS, it automatically runs through our software. It runs through a bunch of checks. We're bringing in additional data on top of it to help us underwrite each individual house very quickly. So when we put an offer in, it's typically in less than an hour after the home has actually been on the market. Because we want to get the home under contract, we want to get inspected, we want to lock up exclusivity for like a week or so then we can really do the deeper diligence, which is great. The challenge with that is when the data itself takes a lot of time and effort to make sure that it's working correctly, and it constantly changes and constantly breaks. So the biggest thing that we need to do is like maintaining the system is the hardest part of acquisitions for us right now.
And if you're in 12 different zip codes, how many different realtor associations do you have to be with in order to pull that data from the MLS?
We don't actually use realtors for that standpoint. There's a website called rapidapi.com, and it's $9.70 a month, and you can basically configure Rapid API to give you all of the MLS data for $10 a month. So we use that for our data feed, and then that it largely works well. Where things break is like when we start adding on additional data on top of that. Like for example, like we want to add in like Brentcast and Rentometer. Like they're not the greatest checks in the world, but like I would rather have them than not. Rentometer in particular breaks all the time. We spend more time fixing Rentometer than any other software in the entire business.
And you're pulling that through APIs as well too?
Exactly.
Yep. How about Zillow? Do you ever try to get data? Now, Zillow, you can't pull Zillow data and store it. Basically, that's one of their things that you can't do. So do you do anything with Zillow data? We
do. So I love Zillow data, in particular on the rental side, because when you list a home for rent on Zillow, about 50% of single-family rent home listings are rented through Zillow. And on Zillow's rental side, it shows you the number of days the home's been on the market, the number of contacts the home's had per day, and the number of contacts, the number of applications. So you can theoretically get like an average contacts and applications per day number for every listing. So if it's like, hey, I've got a home for, let's say $3,500, and it's averaging 10 contacts per day, like that home is probably like pretty competitively priced. It's got 2 contacts per day, it's underpriced. And if it's got 30 contacts per day, it's way, way underpriced. So that data is super valuable, but you can't really get it anywhere. So we have someone we have someone overseas who's full-time, like literally his full-time job is he's going through Zillow, manually writing that data down into Google Sheets for us and then sending it over. Not that the only people overseas can do that. It's just the cost efficiency, I'm sure, is why you have that. We call those virtual assistants, right, Sean? That's exactly right. He is phenomenally smart, and he's awesome. That's awesome. Very cool. So you've got the acquisitions in building this together, Scholastic Capital. So we've got acquisitions could be a bottleneck. Some of the challenges and headaches of the tenants, toilets, and termites, the old 3 T's of SFR. That, as long as you can keep your sanity through that and keep your team through that, obviously, if you've got values that are aligned, that's going to help you. And then the last little bottleneck there is going to be capital. So you've started this fund with Scholastic Capital, and tell us a little bit about the kind of fundraising that you're doing. I'm sure that you've got a room in the fund now, and some of the listeners could even connect with you and say, hey, this sounds pretty good. Tell me a little more about it, Sean. Yeah, it's fundraising's been kind of an interesting beast, and there's a lot of kind of different elements to what we're doing. When we first got started, it was a lot of meeting people, telling our story, meeting people who are excited about it. And we had an initial group of 45 folks who came in on the fund and got excited about it and joined us. Now that we're kind of up and running and we have data points and people can actually buy into the existing fund, so they're actually buying underlying real estate, things have gotten a lot more interesting. So we're finishing up audits right now, where we're going to get listed on a couple RIA platforms where registered investment advisors can allocate their clients' money to us. And we're in conversations with some pretty significant real estate groups about some material checks to come join the business. But we are really excited always to meet folks. We've got a lot of people on the investor side who are from really good school districts themselves, or that have moved themselves to a really good school district to support their kids. So we're always excited to meet folks who fit that definition, because they tend to get it and understand why somebody would do this, because they themselves have moved to a good school district.
How do you make money?
So on our side, we're a true fund model. We're registered with the SEC. We've got a lot of different accounting firms. That's actually probably our biggest bottleneck, is like the number of vendors that we have to use. But we've got what's called an 8% preferred return, and then an 80-20 split above that 8. Meaning, if an investor joins the fund with us, they get 100% of everything that the fund makes until they've made 8% on their money. And then for every dollar after 8%, they get 80 cents on the dollar, and we get 20 cents on the dollar. So I and the rest of our team here, like our incentive is like we have to get the fund to be generating more than 8%, otherwise we don't get paid.
Yeah, and that's all off of that 6% target on the ROI. Mm-hmm. So again, help me, being not high level thinker here, help me understand, if you're making 6%, if you're targeting 6%, how in the world can you pay 8%?
It's a great question. The short answer is and a lot of funds are set up this way, is like, we are short, and we are going to be short over the next couple of years. This is a long-term bet that we're making. To your point, like we're paying 5-6% now. We do have multi-year leases with all of our tenants, so we do have the annual rent escalators built in. So like we see the path to getting above that 8. But for now, like, investors get their monthly cash flow checks. We sent out our first distribution last month. So investors get their monthly checks. We don't get anything. And we continue to build this fund, knowing that as we grow it over the next couple of years, the cash flow rises over the years. And then once we actually sell the fund down the line, then we'll get our 20% from there.
Nice. So how many people are on your team?
We've got 3 people who are here full time, and then we've got our board, which is 6. So, and you could call it 3, you could call it 9.
So, in that regard, just on the structure itself, how in the world do you have operating costs, operating funds, when you're paying the investors the returns? So if you don't have money to operate, I don't understand how it works.
From like a day-to-day perspective, like how we're paying for like Zoom and that sort of thing?
Zoom, and over the labor is the biggest piece. Zoom is minimal, right? That stuff is minimal. Your overhead on your labor and your equity and your people is going to be the most important piece to this, because it's a long-term play. So how in the world do you keep people without having the operation budget to pay them?
Yeah, different story on if it's the board versus the day-to-day team. On the day-to-day team side, our team is international. So we've got 2 fantastic members of the team. One is located in Brazil, and one is located in Argentina. So there's a difference in cost of living that helps kind of bridge that gap. And then for our board, they have equity. So those are, we've got a gentleman from Blackstone, we've got a gentleman from Tricon, we've got a couple of the top multifamily people in the Midwest. So they have equity upside, and that's their compensation for working with us.
Interesting. Well, what's next? If the listeners want to connect with you, Sean, and learn a little bit about the fund, they can find you at is the website the best place to find you at?
The website, and then I'm pretty active on Twitter. There's an awesome real estate community on Twitter, so I tend to share pretty transparently like our full rundown of numbers, what we're seeing, challenges we're running into on Twitter. So always have a really good time talking with folks there as well.
And that's Sean O'Dowd 15, SEANODOD. I'm sorry, DOWD 15. I'll put that in the description too, so everybody can tag along on there. Yeah, that's awesome, man. That's really exciting. And the long-term play here, and you've got it set up. You can tell I'm really pressing into these questions. And before we started, I said, hey, man, is there anything that you don't want to talk about? You're like, no, I'm transparent. Let's go. So we really dove into a lot of that stuff. And thank you for helping me pull, because I don't have a finance background. I don't understand
Mhm.
those types of things. But the structure that I'm seeing here, Sean, is very interesting with the fund and the board. The people that you listed on that board are very interesting because of the exit that you're aiming towards and reverse engineering this product. That's huge. A huge piece there. So, man, if you could go back 10 years and set beside somebody that was similar to Sean, maybe on that same journey in finance and had moved a bunch of different times, the experience and knowledge that you have now, what would you tell that person 10 years ago?
It's a good question. I've got a 4-year-old and a 2-year-old, so I try to think a lot about like things to tell them and like what would I tell them if they were called 10 years younger now. Um, I think the biggest thing is the concept of like unknown unknowns are what can absolutely screw you. And meaning like that's where the business loses money, that's where you lose money, that's where things go wrong. And figuring out like what unknown unknowns are is extremely difficult to do if you don't get to know people who have kind of been through your shoes and can provide advice and kind of help steer you around those roadblocks. So um, I would tell me 10 years ago to or my kids if they were 10 years younger to do everything they possibly can to identify unknown unknowns and try to figure that out. And then I think the secondary thing is I would tell younger me or kids to go values first. So, for example, like our number one value at Scholastic is to protect our investors' shares. Like our minimum investment is a high amount. Like it takes the average American years to save that amount of money, and like if we do something silly and lose their money, like it's equivalent to losing someone years off of someone's life. Like that is just, it's not acceptable. That's not allowed. And being values first makes it really easy to kind of frame decision making and how things work. For example, like we hired somebody 2 weeks ago, and we realized in the first 48 hours, like he wasn't aligned with that value, and like we made the decision to move away from him immediately. And I don't think me 10 years ago would have done that because I I wasn't kind of a values led. I wasn't values led, and I think that's a really kind of critical thing to be doing, especially if you're responsible for other people's money.
Yeah, it's interesting in that piece too, where I was labeling out the areas, the people part, and making sure that the values align through that process. So, yeah, I would definitely echo that as well. And man, just congratulations on this journey and putting this stuff together. It's new, relatively new, the fund process, but
Mm-hmm.
the people on your board, they're on that board for a reason. The groups that they're with, they've got a lot of experience. So just based off of the relationships that you have, it exemplifies many, 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 many much bigger things in the world of investing. So very cool, man. That's really exciting. Again, for the listeners out there today, you can find more about this investment opportunity, just the idea, the process, the package, all of that at scholasticcapital.com, and more about where they're buying, how they're buying, why they're buying, those kinds of things. And then chasing down Sean on X at Sean O'Dowd 15. All of this stuff's going to be in the description of the show. Sean, thank you so much for your time today, man.
Thanks for having me. I appreciate it.
Awesome. And to the listeners out there today, wow, Sean really laid it down. I mean, from the bottlenecks from acquisition into the values needing to align with the people, all the way on the other end of capital, really laid out why this strategy would work. And I hear this a lot in single family of putting together things that grow over time. Not as much as the equity in this particular thing, but it's the equity of the whole thing put together where the true value is. And to do this, you've got to build the right relationships. But number one, those relationships have to be based off of values that align across the board. And when something pops up, that value is not being met, you've got to make a change. Things like this inside of a business grow like cancer. Is just so bad when you don't make a change. If you want to stay in, something because you don't have the time to fix it, that's probably somewhere where you need to make a change. But anyway, so much. I could keep going on that. What an awesome show here. Thank you today for your time and, more importantly, your attention. I do believe that we do share these values. Listening to guests like this, having you guys come on the show, talk about this, it brings me so much happiness. It's really important. That's one of the biggest values I have in my life, is joy and happiness. So thank you for giving that to me here today by listening to us. And until next time, this is the Real Estate Mogul MD.